The US Federal Reserve has delivered its third consecutive giant step with a 75 basis point rate hike to curb soaring inflation and has hinted at the possibility of additional hikes in November and December despite the risk of recession. So what does this latest hike mean for ordinary Americans? What is the impact of this latest hike on South Korea? And what are the broader implications on bilateral trade? Welcome to yet another edition of Issues and Insiders. I'm Min San-hee, and today we touch upon the US Federal Reserve's commitment to curbing inflation, even at the risk of a recession. For more, I have Professor Oh Jun-seok from Sookmyung Women's University. Professor Oh, it's good to have you with us.
Thank you for having me.
Right, I also have Professor Robert Dekle at the University of Southern California live on the line. Professor Dekle, it's a pleasure to have you with us.
Thank you, sir. Thank you. It's a pleasure as well.
Right. Professor O, we'll start here in the studio. As largely expected, the US Federal Reserve delivered an aggressive rate hike to rein in US inflation, which accelerated at 8.3% back in August. Broadly speaking, how does this latest decision by the US Federal Reserve look to affect South Korea?
The Korean economy has been hit hardly due to the aggressive rate hike of the U.S. Fed. And simply speaking, let's imagine this is summer season. The hot temperature implies the inflationary pressure, whereas the interest rate hike is operating the cooling down system. It is normal when you turn on the air conditioner, when you feel that it is too hot. Soft cooling is better than hard cooling just because it is good for health. Nowadays, a 75 basis point of increase is similar to the hard cooling. It is not that good for the health of the economy. And then Korea financial experts expect the Fed rate to be 4% by this year and 4.5% next year. And the U.S. is relatively safe from the energy and food crisis. And then think about the U.S. dollar. Relatively might be most reliable reserve currency under uncertainty. In this way, the dollar becomes stronger and stronger because interest rates continue to rise, and the U.S. economy comparatively better than other Euro areas or China. So accordingly, Korean won continue to lose its value against dollar, breaking 1,400 level today. And strong dollar pains all countries other than the United States. And then import price for the U.S. dropped, but import price for the rest of the world, including Korea, soared up. Which means that fuels the inflation the rest of the countries. So in this way, and then not to mention of cost of foreign debt also increase the rest of the countries. I mean that in brief, slowing economy, rising consumer prices, growing government debt, and then worsening current account balance, and then finally capital outflow. All the negative sign Korean economy will be expected.
You're right. It's a very grim picture for the local economy here. And that being said, Professor Dekle, simply speaking, what does this latest Fed hike mean for ordinary Americans then?
Well, it's going to raise, say, mortgage rates. So that's going to hurt home buying and home sales. And a lot of people are employed in those sectors. So that's going to have employment impacts. But I think what may happen, and what I think it's bad for ordinary Americans, but the only way the inflation rate's going to come down is for the situation to turn dire and bad for ordinary Americans. So it means that companies, when they were able to raise capital pretty cheaply, are not going to be able to do that as much. They may start laying off workers and not giving in to wage demands as much. And so things, the intent is to make things bad for the ordinary Americans. That's the only way the inflation rate is going to come down, provided that a lot of this inflation is based on strong consumer demand. You've got to weaken the consumer for the inflation rate to come down. So yeah, no, it's not going to be good for ordinary Americans at all over the next couple years even.
Right, I see. And that being said then, Professor O, do you suppose the Bank of Korea also has no other option than to perhaps raise its own rates?
Definitely, they will increase the reference rate consecutively. And considering market condition, I mean the Fed rate is 3.25%, while the Bank of Korea rate is 2.5%. Capital movement might be fastly move into the U.S. market. When the interest rate is lower, then from the perspective of investors, it has not much choices to invest into the stock market. But when the interest rate goes up, then from the perspective of investors, there are a lot of choices to diversify their portfolios. So in this way, I might fear about the capital flight from Korea to the United States more than anything else. And then interest rate gap should be kept according to the international Fisher effect. So to stabilize the foreign exchange rate, then there is no other way but to Bank of Korea will follow the road taken, trodden by the aggressive big step of the U.S. Fed. So as a result, I checked the data, and then inbound foreign direct investment into Korea decreased 15.6% year over year to 11 billion in the first half of this year, while outbound investment surged 124% to 25.4 billion in the first quarter from a year earlier. So in this way, the weakening of the won stems largely from the external factors of a strong dollar. But we have to admit that it also reflects some domestic factors. I mean that decreasing consumption and decreasing investment, which means that the business sentiment is not that bright expected. So companies and financial institutions, it is right time to talk about the risk management rather than the return management. And then more than anything else, the foreign exchange rate volatility might be severe, wider. So we have to prevent. We have to make a way to hedging those kind of financial volatility in the foreign exchange market.
Right, I see. And Professor Dekle, going back to the situation in the US, some pundits claim that these rate hikes have been doing little to substantially curb inflation. As a scholar yourself, what are your thoughts on this?
No, the rate hikes, it just started in March, and it takes about a year and a half for them to have an effect. And it's still not... the American economy, given the inflation rate of 8.3%, the real cost of borrowing is still negative given these interest rates. So it's going to take quite a bit more hiking, maybe close to 5% by early next year, for the Fed to be done, and the conditions to tighten considerably. So no, I think. These things like rents, which is a big component of the CPI, 40%. For those things to start come down, the consumer demand has to fall, and for that to fall, the labor market has to deteriorate quite a bit. I mean, I hate to be negative, and that's going to be maybe early 2024. So I do think inflation is going to come down, but it's going to come down relatively slowly, and it's going to be pretty painful for the consumer. Oil prices and supply chain disruptions are going to be gone pretty soon, but unless the economy deteriorates, you're not going to get it down to 2%. That's just a simple math. Things like housing rents have to fall, and a lot of things that are actually pretty sticky. And consumer expectations, wage demands have to fall, like people have to become very negative, and employers have to have greater bargaining power over workers because there's a worker shortage in the U.S. These things are going to take time for it to happen. But yes, inflation will come down, but it'll come down slowly, and it'll be a significant cost to the employment picture in the U.S. For that to happen.
Right, it looks like a painful future ahead then. Professor, then, beyond universal efforts to ease inflation, South Korea has been voicing concern over some of the broader repercussions of the Biden administration's initiatives to stabilize its own economy. One example would be the exclusion of tax credits for EVs assembled outside of North America. Is there a way, that is, to better address South Korea's concerns with regard to EVs? I mean, they have been posting stellar growth in recent times here.
Sonny, you mentioned the Inflation Reduction Act, IRA, which is signed by the U.S. President this August. It gives up to $7,500 in tax credit to buyers of electronic vehicles assembled only in the North America, which might be considered from the perspectives of international trade standard. It might be a violation of national treatment because fair competition in the market should be kept in any cases, and then some import good might be treated differently. That it might be a violation of national treatment. So it sparked the concern that Hyundai Motors and Kia will lose its ground in the U.S. market, and this caused a concern, kind of discord between Korea and the U.S. economic relationship based on the cross FTA. And then I suppose think about the political perspective, and it is practically not that easy to amend the bill before the U.S. midterm election in November. But we remain open to all opportunities, all possibilities to seek various ways to find a solution with the U.S. Congress and its government. But what I'm trying to stress is that Korea's concern extends beyond the details of the IRA itself. That is because Seoul has worked with the Biden administration to deepen the economic ties based upon the so-called trust or competence processes. But more than anything else, supply chain resilience, semiconductors, and then climate changes, which requires long-term investment. As a result, Korean firms have made a series of significant investment commitment in the U.S. areas. But we have to know about the irreversibility of investment. Once investment is made, it cannot be reversible. So, as a result, the Korean companies made a commitment, but the legislation, along with CHIPS and Science Act, could make it difficult for Korean companies to implement or fulfill their pledges of investment in the United States. This kind of sentiment might be considered as both a violation of the trade rule, and then it is contrary to the deepening economic partnership between Korea and the United States. So Korean firms in the long-term perspective, it might be benevolent because by locking up the U.S. EV battery market, then Korean companies gain edges as they develop a new supply chain to meet the legal requirement. But what matters is now that it has damaged the prospect for Korean EVs in the U.S. market, and more than anything else, it could damage the relation between Korea and the United States trade partnership.
Right, and hopefully that will not be the case, though. Professor Dekle, very briefly speaking, though, are these U.S.-centered initiatives, if I may, by the Biden administration serving to ease the cost of living for people there, do you think? 30 seconds, very briefly, what would your answer be, Professor Dekle?
I think it's going the other way. things like tax cut and the new forgiveness of college loans, if nothing else is going to, I mean, it'll help workers, but it's going to worsen inflation because, as I said, anything that increases spending is going to worsen inflation. So you give people a subsidy and they spend more on cars, well, that's going to raise cars and all the input prices. So,
right, I see.
No, they're not going to help at all in terms of lowering inflation. I guess it'll help people in terms of meeting these high costs, but it's not going to lower the inflation rate.
Right, unfortunately.
It goes the
like
other
you
way.
said, if we have, maybe we can talk about this again in about a year's time and see what impact these rate hikes have been having. All right, Professor Dekle, thank you very much for your time.
Yeah. Okay.
Right, and your
Bye-bye.
thoughts?
Yeah.
And Professor O here in the studio, thank you very much for your time.
Thank you.